Hello and welcome to NACUBO. It's great to have you all here. Today we're here for a liaison meeting between the GASB and the National Association of College and University Business Officers, or NACUBO. Very happy to have all of you here in Norwalk. Appreciate you making the time to travel here and talk to us and share your views on the issues you're facing and challenges you may have with some of our standards that you're currently implementing and thoughts you might have on the projects that we're working on. So we appreciate your time very much. Look forward to hearing from you in the discussion. Sue, if you want to say a few words too, and then maybe kick off introductions, if that's how we want to go about the first part here?
Sure. Thanks, Joel. I wasn't sure if we were going to go around the room and introduce ourselves or what you'd like to do, but I just wanted to say good morning. We are really, really happy to be here. It's actually an honor, and we appreciate your time. And we're hoping that we can have a good discussion today. We like to think that there are not necessarily any wrong answers, but questions and answers that need to be explored a bit further. So thank you.
Sure. I think it'd be good to go around the room. I might take a minute, but it'd be good for us to just get faces and places that you might be associated with, and who some of our group is and where we are. So I can start, and we'll go this way. And so when you just press the green button, pause for a second, and then say your name, and then you'll be on camera, and then we'll keep going. But I'm Joel Black. I'm the chair of the GASB, and we'll go to Charlene.
Hi, everyone. I'm Charlene Sweeney. I'm the Associate Vice President and University Controller at Brown University and part of the APC Council for NACUBO.
Good morning. My name is Kelly Perry. I'm the Associate VP for Finance and Controller at Rensselaer Polytechnic Institute and also part of the APC.
Hi, Jeff Praviti. I'm the GASB Vice Chair.
Good morning, Carrie Tricarico, New York University Senior AVP and Controller, and I'm also the NAC representative for higher ed.
Good morning, Carl Strauss, Accounting Director of Oregon Health Science University, and here with NACUBO APC.
Brian Caputo, GASB member.
Emily Paul, a member of the GASB staff.
Diane Ray, GASB member.
Good morning. My name is Lisa Parker. I'm a member of the GASB staff.
Roberta Reese, GASB staff.
Good morning. I'm Justin Noble. I'm the Chief Audit Executive at Virginia Tech, and I am NACUBO's liaison to the Association of College and University Auditors.
Hi, everyone. I'm Shay Bryant, the Manager of Financial Reporting at Michigan State University, and I'm with the APC.
Good morning, everyone. I'm Karen Mahalo, University Controller at Cornell University, and I'm also here with APC from NACUBO.
Good morning. My name is Terry Albertson. I'm the Vice President for Finance and Administration at Ursinus College, which is a small private school a little outside of Philadelphia, and I'm a member of the APC.
Good morning again. I'm Sue Menditto on the staff at NACUBO. Thanks for telling us what that stands for, the National Association of College and University Business Officers. And the APC stands for our Accounting Principals Council. I'm the Senior Director of Accounting Policy at NACUBO.
Good morning. I'm Chris Leach, Accounting Policy Analyst at NACUBO. I work with Sue, and I handle mostly issues from the GASB.
Scott Reeser, GASB staff.
I'm Jackie Reck. I'm a GASB member.
Good morning. I'm Carolyn Smith, a GASB member.
Deborah Beams, GASB staff.
Good morning. I'm Chris Knight, Governmental Accounting Standards Board member.
Good morning. Joe Wickland, GASB staff.
Paulina Otto, GASB staff.
Alan Skelton, GASB staff.
Jackie Lash. I'm with Valencia College. I'm the Assistant Vice President of Financial Services, and I am part of the NACUBO APC.
Good morning, Stephen Phillips, Controller at the University of Utah, here with NACUBO APC.
Thank you for that. It's quite a group. Very impressive. Thank you all again for coming. And Sue, I think probably turning it to you for the next part of the agenda.
Thank you, Mr. Chair. And I'm gonna tee us up and just talk a little bit about higher education today and some data that NACUBO has. And I'll try not to be long-winded. That can be a problem after coffee, but we'll see how it goes. So NACUBO has about 1,700 members, colleges and universities. We're fairly evenly split between not-for-profit and public, but we also have over 50 system offices, public system offices as members. For the last 14 years, we've been doing demographic research on the chief business officer position on campus. That position reports to the president of the university and has many responsibilities beyond accounting and reporting and resource allocation and such. They typically can have human resources, facilities, risk management, and the like. The preparers here today, other than Terry Albertson to my left, who is the Vice President and Chief Business Officer and our Chair of the Accounting Principals Council at Ursinus, are typically report to that Chief Business Officer on campus who reports to the President. So we've changed a little bit demographically, and we started looking at things years ago because we had many vice presidents who were at retirement age or older. So that was 15 years ago. What we've discovered recently is that the average age of the VP is 55. 55% of them are men, 45% are women. So we've made some strides because 10 years ago, only 32% were women. In terms of, people of color, we had 8% in that position 14 years ago, 15% today. Where does our talent come from? 79% of people that attain that vice president rank come from within higher education, which is somewhat interesting, I think. 15% of those were once controllers or financial statement preparers. We know that number has been declining for years. 30 years ago, anecdotally, many controllers became the vice president. And that's not as true today. We don't know if it's because good controllers are and AVPs are so highly prized, or we haven't really leaned into that. So for the past few years, inspired by the pandemic, we like to explore what our top issues are in higher education. And they're not ranked in any order, but what's on the mind of controllers, associate vice presidents, assistant vice presidents of finance, and vice presidents of finance, CFOs. The top issues are investing in essential technology, supporting and maintaining our workforce, communicating the mission and value of a higher education, navigating resource constraints. Those are the top 5 in not any one particular order. I'm going to talk about a couple of them. Investing in technology, cutting edge technology on campus is really, really important in order to evolve the academic and research missions. Students expect it, but we're also under threat, as many organizations are. There are many cybersecurity threats out there, and it's really challenging to stay up with that and to keep highly qualified individuals to help us in that regard. Supporting and maintaining the workforce, this has been an issue reported and talked about a lot since the pandemic of a few years ago. There's a lot of competition from the private sector. It can be challenging to recruit and retain accounting and financial professionals, accountants especially. In fact, there's a decline nationally in CPAs. I think it's about 18, 19%. It's also can be challenging to recruit highly valued and experienced technology professionals. So we try to retain our workforce. We try to provide a lot of professional development and mentoring opportunities in order to do that. If you read the paper online or real paper, or watch the news, higher education sometimes comes under fire. There's some concerns. There's a public that can be a negative public perception because it's expensive to get a college degree. Our prices are somewhat high. People are questioning the value of a higher education, and there are many burdensome regulations we have to keep track of, which can increase costs. And we constantly try to communicate what that value is. We have a research enterprise that has been going on for decades and decades with a research arm of the federal government, several agencies in many cases. That research has contributed to national economic productivity, defense technology, national security, energy, food, medical advances. It's pretty astounding. We also contribute to the local economy, job growth, better health outcomes. There's more civic engagement among college graduates. We see that those who have a college degree have much higher economic stability than those without a college degree. Those with a college degree earn far more than those without. I'm sure this may sound familiar to you or somewhat common, like it's common sense, but lifetime earnings far exceed, if you have a college degree, far exceed those without a college degree. You've got better health if you have a college degree, for example. You save more toward retirement. You contribute more in federal and state taxes, which kind of keeps things going. And those who work in government realize that. And those with a college degree are more likely to volunteer and give back to their communities. So we're challenged with ensuring successful student outcomes. There are a lot of first-generation college students that we need to help succeed. We provide a lot of support services for students, and we're always looking for diverse revenue streams. We face some enrollment challenges. Traditionally aged college students, the numbers are declining. We call that the demographic cliff in our sector. We have endowments. We've seen growth among endowments in the public institution sector for years. And there's a couple of publics that have caught up with the Ivies in endowment volume. Endowments in general support our students. 46% of the endowment payout annually is for aid to students. 16% supports academic research and programs, 11% endowed faculty positions, 10% the campus and its operations. We have small cities and large cities that we call campuses, and 17% is for discretionary purposes. That's based on donor intent or what our governing boards preserve through perhaps unexpected gifts. When you think about what college is and what tuition pays for, it's student services, it's safety, security, mental health, cultural experiences, and of course that thing called instruction and research, et cetera. Many of you, if you tune into higher education, the Department of Education changed its free application for federal student aid, or the FAFSA. The rollout was not easy. FAFSA was delayed by months. That has led to a decline in FAFSA completions in 2024, a year after the rollout, by about 7 or 8%. That decline worries us because of the divide between families who have more versus those who have less, and the decline tends to be among those that have less. We also had an election last week, and there have been many questions. Every time people find out that we are from higher ed, the first question is will the Department of Ed continue to exist? We don't expect that it will be dismantled. What would happen if it is? Could be easier for business officers who have to comply, but we think it would be disastrous for students in the long run. Why are people dissatisfied with the Department of Ed? Well, there's a lot of rules and regulations that go with all of the Title IV money. That's financial aid from the federal government, and taxpayers support that. There's been some discontent over some of the Title IX regulations. It's considered to be an agency that might have some bloat. We can't really comment on that, but that's some of what's out in the public space. We're also watching, with a change in administration, what's going to happen to the federal budget. Will the Tax Cuts and Jobs Act be extended? And if it is extended, as my federal affairs colleagues say, where will the additional monies to fund higher ed come from? Will there be cutbacks in federal aid to students? Will some of our tax exempt statuses be looked at? We already have wealthy universities subject to an endowment excise tax based on the value of their endowment per student. So we're constantly monitoring this in Washington. We have all sorts of resource constraints that we're navigating. Small institutions are now closing at a rate of almost one a week, which is quite astounding. Because we run small cities, the typical deferred maintenance and the modernizing of the campus. And we are over 60% labor. And we all know that labor and benefits cost is quite a big piece of the pie. So that's kind of but I don't want to sound like Debbie Downer. As I said before, there is value in a higher education. We think we can do a better job of explaining our cost structure and helping the readers of our financial statements understand what's going on. So that's a little bit of our climate. Any questions or comments? Or please move on, Sue. That took longer than 10 minutes, but
That was great. A lot of those issues track with what many governments are facing, right? The accounting pipeline shortage affecting the profession. NASAC and the AICPA recently came out with a really good paper from a task force that dealt with public sector specific resource challenges. So certainly some of the challenges you're facing are not necessarily unique, but it's good to hear the specific higher ed kind of bent on them and how the impact, and then you have some unique challenges too. So thank you. Any questions from board members or anything? I don't see any. I think we can go to, I guess, statement 103 is next.
Hi, again, to reintroduce myself. I'm Chris Leach, Accounting Policy Analyst at NACUBO. Pardon me. Before we step into looking at our thoughts and concerns on statements, both issued and proposed, I just wanted to mention that, we are aware that there are exposure drafts and preliminary views documents that are approved and or on the street. We will be providing comments on those as appropriate, but as we go through these issues here, we wanted to make sure that we give you, the board, the opportunity to question us, correct us if we're missing the boat, and also give you a little bit of context by having a real world example of some of these things that would not come across in a dry comment letter, probably. So with that, we're going to start with statement 103. specifically the management's discussion and analysis. And I know there's an implementation guide question in the exposure draft that addresses what we're going to talk about. But the University of Utah has done what I think are some very interesting and very useful things with their management's discussion under existing standards. So with that, I will turn it over to Stephen Phillips from the University of Utah.
Thank you. Good morning. First of all, let me say thank you to the board for allowing us to come talk with you and present our views on this. As mentioned, my name is Steve Phillips. I'm the controller at the University of Utah. I was asked to present on our perspective on Statement 103 and what it may do to our MD&A as it's been revamped over the last couple of years. And more specifically, the concern that we have with the potential upcoming implementation guidelines and the negative impact that could have on what we're trying to accomplish as what we see are the crucial goals from Statement 103 with the MD&A. So as you can see on the screens, these are kind of the 4 things we picked out of Statement 103 that we felt were the kind of the key crucial things that should be coming out of our MD&A. So provide an objective and easily readable analysis of the current financial state of the institution, and in particular, the changes from the prior year. We need to make sure that the analysis is easily readable and understandable to someone who is not familiar with or an expert in government accounting, which there's not too many of those out there. Third, the analysis needs to be based on facts, decisions, and conditions so that people can feel comfortable and confident in what we're telling them. And then the last piece there is it shouldn't be boilerplate in nature. And we believe that boilerplate concern really should apply not only to the explanation or the language that's used to describe the changes, but also in the format or the layout of the MD&A. And I'm going to be spending a few minutes talking about why we feel that's important. So, the big concern there is forcing that layout to be templated, which is potentially what's coming is, while that does provide comparability from institution to institution, it can also restrict our ability to provide a comprehensive and easily readable and understandable analysis to the non-accountants. And, the way we see this, the MD&A should really answer the so what question, especially for the non-accountants that are reading it, right? The accountants can read the statements, they can read the footnotes, they can understand those things. But for the non-accountants, the MD&A is really the piece of the statements that helps them understand it. So, Chris, if you'll go to the next slide. In fiscal year 23, we decided to revamp our statements. We've stuck with that through fiscal year 24. We've made some improvements, which has been great. But when we were looking at revamping it to try to better answer that so what question that I mentioned, we started looking at and brainstorming about how would this look? How could we put this together? And as we were doing that, we thought about the 3 big strategic goals the University of Utah has. And those are what are on the screen. That's growing our student body to 40,000 plus within 10 years. Now we're a couple years into that and we're on the right path. Second goal is increase research funding to $1 billion plus. And then the third goal is to improve or impact the lives of all Utahns. Okay. And we knew after we looked at this, that the students, the public, the state legislature, et cetera, they all understood these goals because we had done a good job over the last year plus to help them understand what those goals were, how we were going to get there, and what they meant to the university and to the community as a whole. So we decided to realign on those 3 goals. And at this point, the results, based on feedback, have been overwhelmingly positive in nature. Chris, if you'll go to the next slide. So not only did this help readers better comprehend or tie changes in the financial numbers to things they could see and understand as non-accountants, but it also better aligned the strategic decisions we as an institution were making with the impact of those decisions on our financials. So I want to give you a couple examples, and what you're seeing on the screen is just one small piece of the Inspire Student Success section. And there were 3 main sections to our MD&A. And those aligned with the three big goals. Okay, so this is the one that aligns with growing our student body, which, as I mentioned, was to get it to 40,000 plus within 10 years. So in this section, we were able to take many aspects of our financial statement changes and put them in one place that made sense to non-accountants of how that changed our financials. So we talked about things like increased tuition and auxiliary revenue, or how our tuition discount increased as we as an institution tried to provide new and returning students with aid that would help keep school affordable. Then we talked about how our capital assets went up because as we grew the student body, we needed more housing, or we needed better places to provide instruction, or to provide that instruction in a way that makes sense in the current environment. And then when you talk about new capital assets, well, okay, how did we pay for those? Well, we may have used some cash or gifts, or, you know, we used appropriations from the state, or we may have issued some debt, or some combination thereof. As I mentioned, the second goal was increasing our research. As we have explained research in the past, you know, we did everything we needed to meet the requirements of what had to be in the MD&A, but it didn't really answer the so what question. Under this new view of things, we would talk about how the new research provided learning opportunities for students that may not have existed in the past, or we've actually had to increase some capital assets there too, as we provided places for that research to take place. And then we talk about what came from that research, all the discoveries that were made. And those discoveries kind of lead to that third goal, which was impacting the lives of all of the Utahns, okay? Well, as we made those discoveries in medicine or technology, we would tie that to how that changed the numbers on our financial statements, but how that also impacted the health of Utahns, or maybe environmental impacts as technology got better so we could reduce the environmental impact within the state. You know, we have some pretty bad air in the state of Utah, especially during winter, that can harm a lot of people. So those are the things we started trying to focus on, and we redesigned to allow those non-accountants to see, like, this is what you can see and feel and understand, not just there was a change in the number. And we're concerned that if we're required to go to more of a boilerplate on the MD&A, that it'll kind of force us back to more of that historical way of looking at the numbers. And in fact, I can tell you from talking to my auditors this year that that's what they're expecting and what they want, because it makes it easier for them to audit. And that's great, but it doesn't make it easier for the users to actually read and understand. I appreciate your time. If you guys have any questions or comments, I'd love to hear them or answer anything I can.
I just have a point of clarification. So you address every requirement.
We do.
You just shuffled your deck
Yes.
around your strategic objectives.
Correct. We did. So yes, instead of sticking to that layout saying, well, this is your financial analysis, or this is your debt, or this is your whatever, we just structured it differently so that it was more understandable to somebody that wants to see the so what, or what does this mean to me?
Go ahead, Lisa.
So first, Stephen, you and I have talked before, but
We have.
let me first start by saying what you show me here gets me so excited, because for many, many, many years, I was GASB's SEA, Service Efforts and Accomplishments reporting sort of cheerleader, if you will, on the staff. And a lot of what I see here, right, resonates with me from that perspective, where we talk about our goal and our objective and how we're going to measure success on that goal or objective. You are speaking right to my heart. So let me first applaud you for that. I think when we think about MD&A, you know, the board was coming at it from the perspective of, one, creating greater comparability, right? So that if I'm a user and I am a user that's making quick decisions based on my review of those financial statements, I can look at Lisa's government or Roberta's government and know right where I need to go to get that data or that information that I need to make that decision. The other thing is that the focus with MD&A is really a financial focus, right? Although great information in what you're showing me here, the focus is really about financially the numbers, and not necessarily with that communication device on goals and objectives and that sort of thing. But rather what we tried to do in Statement 103 was really hone in on the fact of, hey, don't tell me something went up by this percent or this dollar amount. Tell me why. Tell me your story, but tell it within the confines of telling your story in how it relates financially. So the comparability was a big thing. I know you touched upon boilerplate, and you and I had talked about that previously, how the boilerplate is not from the format, but rather the boilerplate is more from how you tell that story, because previously you could look at government ABC and government XYZ, and they would look very similar. And if you were to look at GASB's illustration from 34, it looked very similar to that as well, because people weren't being creative, right?
Mhm.
Like, obviously this was a lot of work, and you've put a lot of creativity into that. So we were coming at boilerplate from the words, not necessarily the deck, as Sue very eloquently laid it out, because the deck is important for comparability, as I said, so users know where to go.
Mhm.
The other thing I will say is, required supplementary information. So by its very nature, it being an RSI, it has to include what's required, right?
Yep.
Not anything outside of that, but rather just what the requirements are, which are those 5 areas to touch upon. So I know that's probably not the answer you want, but hopefully it gives you expanded perspective on why the board made the decision that they did. And why it's in an implementation guide Q&A now as well.
Brian?
Just a question. Steve, does your institution participate in the GFOA certificate program?
We don't at this time. It's something we're looking at doing.
Okay, the reason I ask that is that for more of the free-flowing creative types of things that you're doing here, typically, I've seen them in my career incorporated into a letter of transmittal that kind of gets at this. So I don't know if maybe that's something to think about.
So we have thought about that at the university, and it is something we're considering doing and making the financial statements as part of a bigger report for the university on the university as a whole. But one of the things, and I understand what Lisa's saying as well, we still feel like there's a way to get to the required information, the RSI, in a little bit different format that maybe makes it more understandable while doing it within the light of financials. So we are looking into all these things, and obviously we'll comply with whatever the requirements are, and we'll still try to look for ways to be creative within the new formats. But we just wanted you guys to see and understand some of the things we've been trying to do to make this better for our users. And one of the things we were hoping to see, and we've seen a little bit, is that especially for like state legislators or people that are not accountants, this helps them understand where the money is going a little better. Instead of having to try to have their financial analysts explain it to them, they can just read it and understand it.
Go ahead, Sue.
I find the discussion really interesting. And, we have a saying in higher ed, if you've seen one college, you've seen one college. And sometimes, it's hard to compare or benchmark financial information across our sector. You can get closer by leaning in and looking at institutions that might have similar numbers of students or similar volume of research, et cetera, et cetera. I don't know if there's an analogy. If you've seen one state and local government, you've seen one state and local government. So I often am very curious about the notion of comparability. I think comparability in terms of form over substance makes sense. So as I was listening to Stephen, and I know the requirements in the 103 are really about the 5 categories of MD&A, and it is a financial focus of the 5 categories. And what if a set of financial statements had a crosswalk of the MD&A sections to the 5 categories, so that users or anyone seeking comparability for structure could easily find what they were looking for. So it allows someone to tell their story, but the information is easily located. I just wanted to ask that question. Thoughts?
Maybe give us a second. Jackie had her. Do you want us to answer Jackie, or do you want to go ahead and comment?
I was just going to talk to what Stephen had presented, not to respond.
Yeah.
Sorry.
I don't think we'll have a response for that, Sue. I would say as I listened to it, and I don't know if I'm hopefully not stealing what Jackie's gonna say. You know, you talked about the so what, and we don't usually say the so what, it's the why. Like, why did it change? Why did this, balance go up or down? Or what was the government doing that created that change? And I heard in your discussion that was in there, right? And I think there's a lot of that in there. And so to me, if you look at the detailed analysis kind of in the middle of the 5 requirements, a lot of what you described probably could go in that detailed analysis and would serve to articulate that why. And we don't want you to duplicate. So if there's capital asset and debt information in there, maybe when you got to that section, you could just reference, hey, this, very summary, these were analyzed there. So I think there's a way to fit a lot of what you just described even into the structure of what's going on in the MDA. Haven't read it, so I don't know exactly if all it's in there, so I can't say every bit of it would, but I think that there's a way to without having to necessarily be a crosswalk, I think there's a way to just kind of fit it in and still have all that good information. I do think I've heard that same saying about every type of government. You've seen one state, we hear that about all of them. And that's true. Like we wrestle with that, we deal with that, we provide optionality in our standards in a lot of ways, but we try to help create comparability so that a state legislature in Utah who might be wanting to look at, a state in a university in Nevada or in California or in Georgia have some ability to try to compare and look at, well, what is University of Georgia doing or whatever compared to this, or an investor, right? And so we're trying to create some amount of comparability within it, but we do want the MD&A to tell your story. It sounds like you're telling your story really well, and I think it seems like it could fit in even within a little more structure than you'd hope to have. But Jackie.
So I'm going to piggyback a little bit on what Joel said. First, a little on my background. I am in higher education. I was in administration. I was associate dean for finance and budget in my college. So I get what you're saying. I've been involved in strategic planning. I want to applaud you for what you have done, which is tie your goals to finance. Too often they are totally separate and they're never talked about in alignment. And I would hope that you would keep that good information in there explaining why your numbers are what they are because of what they have done to help you with your strategic goals and how they align. I think that is great that you're including that. And I hope you continue to do that, even if you switch it around or flip it around a little bit to meet the requirements, because I think what you're doing is great.
Anybody else on MD&A? Chris, did you have more on 103?
We do. Let me share the screen again here. With 103, one of the other things that in the higher ed space we love about Statement 103 is that Pell Grant revenues are moving out of non-operating up into operating. We think that's there we go. We think that's more representative of how the university finances its operations. So we wanted to talk about what we think most institutions are probably looking at for their new Statement 103 presentation relating to Pell Grants, and hopefully get a little bit of feedback from y'all about whether or not we're kind of barking up the right tree. Currently, under Statement 34, the typical presentation for operating revenues is going to show student tuition and fees net of a scholarship allowance. Colloquially, that's called the discount, but it's not what most people think of when they hear discount. And for a lot of institutions, the majority of that, in this case, 11.8 million, is the application of Pell Grants to student accounts. So, it is what it is. This is what most institutions currently present. Based on our conversations, we think that what most institutions are thinking when they move to Statement 103 is simply adjusting the geography on their statement of revenues, expenses, net position, and simply pulling that Pell Grant line right up into operating lock, stock, and barrel, still showing that scholarship allowance associated solely with tuition and fee revenue. So that's what we think people are going to do. They're going to end up in the same place. The operating revenues under 103 are going to be 40, in this case, 49.8, but we think that there are potentially some more meaningful ways that could be represented. I'm not a big fan of this approach, but it's one that we've heard some people talk about. And that would be to show the discount in line, as it were, not having it specifically associated with tuition and fees, but say, okay, Pell Grants, the purpose of those is to help a student finance their education. So we'll show our student tuition and fees. We'll show the gross Pell Grant revenue, and then we'll pull out those scholarship allowances to come up with what we've called here net student tuition and Pell Grants. And then you add in the other operating revenues that the institution has, and you come back to that operating revenue amount of 49.8 million. As we started thinking through this, though, we kind of came back to the concept that what really is the discount? What is that supposed to represent? And as I mentioned a few minutes ago, the common understanding of that term discount is, hey, it's on sale for $29.99 instead of $49.99. So, hey, you're getting a $20 discount. And that's a decision being made, in that case, by the retailer, the vendor, whoever, to reduce the price. That's not what we are presenting here, because we are showing those Pell Grants applied to student accounts. So it's a little different from what the common person on the street might consider. So we got to thinking, well, is there a definition of discount? And we may have overlooked it, but as best we can determine, the only place discount is mentioned in the literature is a footnote in Statement 34, which simply says revenues should be shown net of applicable discounts or something to that effect. So we got to thinking, all right, let's think about a different way to show it. And what we would do here in this presentation is we would bifurcate what we currently call discount or scholarship allowances to show Pell Grants applied to student accounts as a discount on the Pell Grant line. And then that would make the student tuition and fees scholarship allowance more in line with what we think users think of when they hear discount. the university has waived tuition for somebody. So they've cut their listed price for somebody. That, in our view, gives the users a better feel for what institutional resources are actually being applied to assist students in financing their educations. Pell Grants, that's not an institutional decision. We understand that there's perhaps an implied objective of not double counting the revenue, once as a Pell Grant, once as tuition and fees. But we feel that it's a lot more representative of how the institution is actually operating, gives a better picture to the users of the financial statements of what true institutional resources are being provided to students. That's essentially all we've got on that issue. We just wanted to, get a little bit of feedback, perhaps. Are we barking up the wrong tree? Does this seem like a reasonable approach? Again, I think I speak for all of public higher education. 103 is great in terms of what it pulls up into operating. The fact that it pulls state appropriations up into the non-capital subsidies. So there is a subtotal there that is more representative of the actual operating activities of the university. With that, I'm happy to address any questions or comments.
So I do have a question. My question would be, in the better presentation format that you're alluding in your slide, have you taken into account and consideration the provisions of paragraph 5 in statement 24?
We have, those of you who have been involved with this board for a while may know that there were some times in the past where NACUBO would come to meetings and say, why aren't Pell Grants treated as agency transactions the way they're handled on the private side? We're not going to beat that horse. We accept the fact that 24 is saying that is a revenue. We felt that better presentation is still providing the information on the revenue side of it. It's simply a matter of adding what's the net amount that I'm showing plus that discounted amount. That will give you your total Pell revenue. One alternative we thought about, but sort of rejected because we felt it was a return to the bad old days, so to speak, was, okay, if we're going to pull the Pell revenues up, does it really make more sense to move all of those amounts applied to student accounts and in some cases dispersed to students? Does it make sense to start showing those as part of your student aid expense, as an operating expense? Like I said, that's the bad old days. That's pre-34. That's certainly not, indicative of what it is. The university doesn't really have an expense per se, but we recognize that if you're recording under 24 the revenue, then you're required to show a reduction of revenue somewhere related to the amounts applied to the students.
The provisions of statement 24 talked about revenues and expenditures or expenses. And so what it strikes to me, and this would be my personal opinion, the board has not waited on any of it. I think your presentation resembles more of an agency transaction as it would have been in the private sector.
Point well taken. I mean, we recognize that that was a potential criticism, was that you're trying to bring agency accounting in through the side door. If that is sort of the final judgment, as it were, then
You asked me for my feedback. It's no judgment.
yeah, no, and
my
I'm just saying, you know,
personal opinion, Paulina,
Yeah.
perception, not the board.
yeah, and you know, the other two potential presentations that I showed will get you to the same place. It's just a matter, sort of dovetailing with what Stephen was saying. That better presentation we thought was an approach that potentially could be complying with the appropriate literature while still better, quote unquote, telling the story. So I appreciate the comments. Thank you.
Because I think that so you had the current version, you had what you thought most people would do, and then you had one that was longer. I understand the messiness of that, but like you noted, I think footnote 41 of statement 34 would get you to that one, right? I mean, that's what we were thinking about. I mean, I couldn't weigh on whether the prior one or the extended one. I mean, we wouldn't opine in those because we would think that that's consistent with the standards. But the last one gave me personally a pause of concern because, like you noted, it feels like we're backdooring through agency relationships by showing a net when the provisions of 24 tells you revenues and expenditures. And we've always had this issue with what do we do with that piece of the transaction from the Pell side? I mean, I understand the complexity, but it just opened that challenge.
Thank you, Paulina. I think we did push the envelope a little bit on that last presentation, just for illustration and contrast. I personally like the extended presentation. It adds a line, but it shows what we're doing today, but it better explains what we're doing today on the face of the statements. And it sounds like that perhaps makes some sense to you as well.
More than the quality of information, what my thought was, and my reaction to that presentation was, is consistent to footnote 41.
Okay.
That was my reaction to it.
Yeah. Thank you.
Anybody else have any comments there or questions? We appreciate you bringing it to us.
This is what we asked for. And maybe it falls in the category of be careful what you ask for, but
Some things do.
We do appreciate the feedback. What we would like to talk about next is getting into statement 101. We're going to start off with Shay Bryant from Michigan State talking a little bit about how they have been analyzing specifically sick leave under 101. And then I'll have a couple of remarks after Shay's presentation. Just tell me when to change the slides.
All right. Thanks, everyone. And what a pleasure to be here as someone who's spent his career auditing and now implementing GASB standards. It's really great to be where the magic happens. This is very exciting. I want to spend a few minutes talking about the model we're working on at MSU, show folks how it could look, a potential approach, some lessons we learned, and then hopefully lead into a conceptual discussion that has caused some, back and forth in our group, and we think will be very critical to preparers to, on how they should be thinking about this concept. So a little background at MSU, we pay out on sick time at half the hours accrued when someone retires. To retire, you have to have had 25 years of service at any age or be age 62 with 15 years of service. And you accrue 4 hours every 2 weeks, about 104 hours a year. So that's kind of the backbone of what we're doing here. So on the screen, you'll see this is an individual. We basically run this calc for every employee. This is thousands of employees. And we're trying to decide the fate of the accrued sick balance. What piece is going to be used? What piece is going to be paid out? This example individual is 51 years old. They've been with us for just under 16 years. They have 1,000 hours of sick balance accrued, and they make $50 an hour. So if we're trying to estimate the usage component, the assumption we're making is kind of a FIFO approach. I don't know if we're allowed to say FIFO. If they're using their time, they're using those first hours earned. That's what we've built this on. So If we assume this person is going to go to retirement age, which was 62, that means they'd be with us for 11 more years, and we've estimated an annual usage of 60 hours. This is more detail than you need, but we're having trouble with the data. We're working on it. 60 is a plug for now. Could be more, could be less, but I think that'll feed into our later discussion. But for now, we plugged 60 hours in. That looked kind of reasonable based on some of the good data we could pull. So theoretically, over the next 11 years, this person will use 660 hours of sick time. And then to calculate that usage component, we take the 660 hours used, time the hourly rate, and we tack on the retirement match. We match 10% retirement on folks when they get paid out. This would go through the normal payroll process, and we tack on that 10%. And then ultimately, payroll taxes happen later in the workbook, but you could say payroll taxes and that retirement match are on the usage component. If you would, Chris, the next slide. So looking at the same employee, if we estimate they're going to use 660 hours the rest of their career, that means at the end, we would pay out 379.5 hours. I'm sorry, that would be the remainder. That little max payout, there is a cap on certain union groups. That's what that's designed to check, not relevant to this individual. And then we would pay out the half, as I mentioned. So the 189.75 is what would actually be paid out. And also of note, when we pay out, we don't pay the retirement match on that piece, just the payroll tax. So to estimate the payout component, we would take the 189.75 payout hours times the hourly rate, and then tack on the payroll tax to get a payout component. So if you would, Chris. And then the last input here is that column, or the cell E, the probability of retirement years of service. We've used this for many years in the current guidance. We've got a regression analysis, basically how many folks that were hired 25 years ago are still here, 24 years ago and still here. We can run a regression analysis, put it into 5-year tranches and say that's the chance this person is going to get to that 25 years of service. So we've shown through our history, if you're here 15 to 20 years, there's about a 74.5% chance you're going to go all the way, make it to 25 years. So we add that estimated usage component, the paid out component, to get a gross liability of about $46,000. And then we say there's about a 74.5% chance of that playing out to get our weighted liability. We run that calculation for every employee. And then since we're using that air quotes FIFO approach to estimate the current liability, we're just taking 1 year of usage and saying that's our current sick liability. So maybe I'll pause there. Any questions on what we're seeing so far? Okay. If you would, Chris. So as we're picking at this, trying to go individual by individual, we're working towards precision and then seeing, at what point does it stop helping us to get more precise? Some of the extremities, it doesn't make sense. A 65-year-old with 4 years of service, a new hire that's 59, the calculation breaks down. The probability is only based on reaching that 25 years of service. There's no age component. Is someone going to reach that age of 62, so forth? And then it doesn't, there's also some other categories of employees, not relevant to this example, but we didn't factor in any of those shifts. So it's not perfect, but if you would, Chris, the next slide. As we were beating ourselves up, pulling on some of these levers, the liability wasn't moving much as we tried to refine it further. And we took a step back and said, if an employee quits tomorrow, we overstated that entire liability. If someone makes it to retirement, we understated it because they're getting that full, it's not being reduced by 74.5%. So on the whole, we think this is pretty good. We think it's a reasonable estimate. It's materially correct. Further refinement doesn't add much to the calculation. And then, as I mentioned, the usage, we will be looking at, is the 60 hours reasonable? Does it vary by age and union groups? That may change some of our conclusions. But I'll pause there. Any questions at this point on what we're doing? Okay, Chris, if you would. So just to show the scale of the change, our sick liability in 2023 was about 41 million. If the 60 hours of usage is correct, it'd be about 64 million. If that swings 30 hours either way, moves a little bit. So like a 50 to 60% increase in our liability. So decent jump. If you would, Chris. So the big conceptual question, as I mentioned, we're using that FIFO approach, but our policy doesn't say anything about that. It doesn't say the first hours used are from the accrued balance or vice versa. We went with FIFO looking at it from the perspective of like this individual's got 1,000 hours. Next year, they're going to accrue another 104 hours. So when they're using time, the vast majority is old. So maybe it makes sense to say, yeah, they're using some of that accrued balance. So this makes sense. It's not 100% old balance, but most of it. And it also seemed to, frankly, better align with the basis for conclusion in the standard. It sounded like the board was close to saying FIFO needs to be implemented for everyone. Backtracked a little bit because there were some examples of LIFO. So we went, okay, that might be what the point is here. The counter argument that we've been having inside is that, even in our example, if we're using 60 hours and accruing 104, this the average person is kind of stacking 40 hours on each year. Can we ever say that they're using that old balance? Is it more of a LIFO approach? This thing's going to build and build and build. You know, this person's up to 1,000 hours after 16 years. Could we really say that's not true? Maybe it's more likely than not they're using the old hours first, and there is either no liability, or for us, it's just the payout component. Does that make sense? So I could wrap my head around either approach. The FIFO made sense to us, but yeah, that kind of LIFO view makes sense too. This accumulated balance is growing and growing. Maybe they're never chipping into that old balance. So that's the big conceptual question we're wrestling with. Would you phrase that any differently, Chris? That's kind of where we're getting stuck. Because we could rationalize both, maybe neither is more likely than not, and we just say, none of that met the threshold. We're looking at the payout still, or if you don't have a payout, there is no liability.
Good, Deborah.
So thank you for sharing your experience with us. It's always good to hear how this is working in the real world. You said something, I think on one of these previous slides, a very key word, especially with this statement, I think, is materiality. The materiality box is your friend in any GASB statement, but particularly this one, I think, because our research showed that compensated absences for a lot of governments isn't material. Or some of those maybe changes in assumptions or your methodology wouldn't make a material difference. And so, you know, if it's not materially different, it's fine from the 101 perspective. As far as the flows assumption, that's probably been, we haven't had a whole lot of technical inquiries on this standard still at this point. But that's one that's come up a few times. And as you know, there's nothing in the standard that prescribes a certain assumption. The basis talks about the board did consider requiring basically FIFO for most everybody. That was proposed in the exposure draft, and then it was backed off in the final. And so ultimately it becomes an accounting policy decision. It's an assumption that goes into the estimate of the compensated absences liability. So it's open for each government to make their accounting policy election. Do we want to assume a FIFO flow or a LIFO flow? And either one are allowed under the standard. Which one is the right choice for a given government to make? That's up to them to make that judgment. There may be a few cases where there is an employment policy that specifies how hours are used. That might play into the decision. There might be a practice of how their system tracks those hours and kind of an implicit policy in there. But if there's not, then it's an assumption that's open for them to make.
Great, thank you.
I agree with everything that Deborah just said. I'm gonna add one little thing to it. It's not whether you have a policy or not. You need to have a policy. Now, it might not be an HR policy, might be just an accounting and financial reporting policy, but it's not that when you implement 103, you'll be absence of policy. No. Part of 103 will be stating for financial reporting purposes, what is your policy? Is it LIFO? Is it FIFO? It may be that you don't have anything that points you a certain direction. It might be that you don't have a statutory. It might be HR doesn't have a policy, but for purposes of this, you'll have to have one. You're right. We took that out of the ED to give governments flexibility in what it is, and we don't really say what it shouldn't be, but it will be. Every government, every person under 103 will have to determine what that policy is. So I agree with what she said. Great.
Thank you, Shay.
Shay and Deborah stole most of my thunder. So I'm not going to have a lot of comment here. But kind of where we started looking at this was as we started talking with various institutions about their implementation of the sick leave liability required under 101, we found that there was just sort of a knee-jerk reaction to do something similar to what Shay described. And people were saying, okay, on an average year, people are using 35% of what they earned in that year. Therefore, we're going to apply that 35% to the end of year balance. And as we started looking at that with them, we started seeing that there were going to be some huge liability hits at some of the larger institutions, tens, if not hundreds of millions. I think Shay, yours was 20-ish. And across the public higher education sector, we thought, that could be almost a $2 billion, that's pulling a number a little bit out of the air, hit, recognizing a liability and reducing beginning net position. So we went back to the statement to say, okay, what might there be that institutions can look at, still be in compliance with the statement, but minimize to some degree the hit on net position that they were going to take. The concern is not over the annual amount, because that's simply the change in the liability. It was that opening hit. And in the statement, there is a lot of discussion about how there is the exercise of professional judgment, whether it's the FIFO, LIFO, any number of other things. So we started thinking that, okay, if you're trying to determine what's more likely than not to be used, in addition to looking at usage trends, you have to look at what's happening with your accumulated sick leave balances. And as a general proposition, we said, well, you know what? If balances are increasing year after year after year, that means people are not using everything they have earned in that current year. So if in our judgment, we can say, well, that means they're using current year leave that they've been credited with, and little or no of that accumulated balance at the beginning of the period, then there's a lot less of that opening balance that you would think is more likely than not to be used. So that's sort of the genesis of where we came at this from. Aside from that, like I said, Shay and Deborah kind of stole my thunder. So again, any questions or comments, happy to address them.
Can you ask a question? Can you just help me understand, I guess, in my mind, how a balance increasing tells you what leave they used? Because a balance could increase, and that means I could have used old leave or new leave. So how does just the fact the balance is increasing get you to that answer?
Because you've got the latitude to essentially say we're going to use LIFO or FIFO flows statement. If you say, all right, we'll say LIFO. If the balances are increasing, then you can say, okay, at the beginning of the year, I had 100 hours. I earned 60. At the end of the year, my balance is 140. So that balance is increased, but it increased by less than the hours I got in that year. So if you're saying then we're following that LIFO flows assumption, then you can go back and say that means we did not, or that employee did not use any of that opening 100 hours.
Once you make the LIFO assumption, I agree. But in that scenario, I had 100, earned 60, used 20 essentially. That 20 I used could have come out of the 100 bucket or could have come out of the 60 bucket. I'm not sure the graph tells you which bucket it came out of.
The way I've felt better about it is not necessarily that I guarantee it's LIFO, it's that since either works, neither is more likely than not, and I can pick. That's kind of how, because I was pushing more FIFO initially, and then they've convinced me that, yeah, I can't say it's more likely than not, so it's a policy call at that point.
Well, the more likely than not is how much is going to be used, and then it's the question of which bucket did it come from.
Exactly. We don't,
right?
Don't know. There's no way to tell, so yeah.
Yeah, I mostly wanted to say we weren't looking for a liability avoidance as much as we were, we were asking the question, are colleges and universities doing the correct analysis, or, you know, are you looking at it in a few different ways? Because more likely than not is an interesting assessment of a 50%, at least 50% likelihood. It's a probability analysis. And we do see that some of the benefits in higher education, the amount of sick hours, especially for schools where it doesn't vest at all, that they're really earning a generous number of hours per year. So maybe you're earning 120 hours a year, and on average, people are using 35. That's an awful lot of remaining hours that are never used that could carry forward to the following year. And then there's the next year, and they're using 35, and you're carrying forward, et cetera. And we were also hearing anecdotally that since the pandemic, with some of the flexibility in work environments, we were actually seeing the usage declining from 35 to 30. I know when I've had the flu this winter, it's like, yeah, I put in 3 or 4 hours a day, then said, okay, I got to go to sleep. But I didn't, stay home from the office and use 8 hours a day. And we were seeing those types of patterns. So we just wanted to make sure that the schools were doing the correct analysis. Alan, I loved what you said, and I wrote it with a star. We need a policy. If you don't have a policy or there's no statutory requirement, the analysis we're doing might reveal that we ought to have a policy if we're going to look at accelerating balances. We also thought that hours are fungible. It's like you earn, you take, you earn, you take. So we just didn't want to write accounting guidance or a suggestion that would really fly in the face of the board's intent. And that's why we're bringing it forward today.
Yeah, Sue, I appreciate that. My point was some governments might have a statutory provision that says this is what you do. Some governments might have an HR provision that says this is what we do. Your system might be set up to do A, B, or C, but in a lot of cases, it won't be any of that. It'll just be be hours went in a bucket, right? And so I think what we envisioned, I think what the board envisioned was, well, then from an accounting and financial reporting standpoint, we have a flows assumption policy. We have an assumption of what our policy is on how they flow, and you have to make that. And once you make that, then you can look at the math and look what Shay's done and see if it all makes sense. But step one to me is almost, what is that flows assumption? What is that flows assumption? And so it's important. And Deborah explained it very well.
Yeah, just one last comment. I think another thing that Deborah pointed out was the whole issue of materiality. We were not seeing in the discussions we were having, we were not seeing people taking that into account. Obviously, if you're saying somebody's going to have $100 million hit to opening that position, that's probably going to be material, but maybe not. Depends on the school. That is an issue that we want to make sure people do take into account. We polled a few institutions just to ask what the magnitude of their implementation effort was for 101. And we've gotten back out estimates ranging from like 40 hours to as many as 300 or 400. And got to thinking, if the materiality is not there, you really only need to take the time to make that determination and then cut and run. So thank you for mentioning materiality. That's certainly something we need to make sure we make our members, request that our members take into account.
Chris, you made an important point there when you talked about cost benefit, right? You were kind of alluding to cost benefit. When the board makes a cost benefit decision, which we do on every standard, we assume you're applying it to the material items because we have the materiality box in every standard. And when you apply the standard to items that aren't material, or to such a degree that you're so precise that you went way beyond in your efforts to get to that number, not just to a materially correct number, then you raise your cost of compliance beyond what the board anticipated. in their cost benefit decision. And so I applaud anybody for encouraging people to talk to their auditors, figure out what materiality means to them in every situation and apply it, because it should be.
Well, at least we have no more slides.
Slides are good. We're okay with slides. Move next to infrastructure, looks like.
Yes, and really there, our main concern, obviously that's a PV, so it's sort of 2 steps removed from becoming something we absolutely have to deal with. Some of our members, APC members, as well as some other universities, have expressed some concerns that the PV would require institutions that do not use the modified approach to make certain disclosures that they're not currently required to make. Existing literature, I think, has a strong suggestion that the disclosures should be made that the folks using the modified approach would make. And there's a lot of concern expressed to us that putting those disclosures in, if the institution is not using the modified approach, would potentially open up some legal liability if they say, we've got this infrastructure asset, we think it's going to be around for forever. We expect we're going to spend X amount per year, and then all of a sudden they've got a replacement that they have to do, and it's a lot of money, and we're just it's been expressed to us just a little bit of a fear that that's going to open up a can of worms that may be a little more problematic, and certainly something that I think there's a little bit of an attitude of, if it wasn't broken, we don't need to fix it. And we don't think it was broken in terms of those disclosures that would now be required. Sue, is there anything that I missed on that? That's all I can recall.
I don't think so.
Oh, okay. Sorry. Was it on the whole time? Oh, okay. Yeah, I mean, the board, when they deliberated, or in their deliberations leading the preliminary views, they did consider each of the current information that's required to be presented as required supplementary information for those governments that report infrastructure assets using the modified approach, as to whether all governments should present that information as a note disclosure, including governments that use historical cost net of accumulated depreciation to report their infrastructure assets. And really the only item that is currently required to be presented as RSI for governments that report infrastructure assets using the modified approach that the board decided to include as notes for all governments is the amount of maintenance and preservation costs during the year. And so the other items, such as, what the condition assessment of the infrastructure assets and things of that nature were not decided. The board decided didn't meet the requirements or the conceptual requirements to be included as note disclosures. I will say, in considering the cost benefit of providing maintenance preservation costs, the board looked at it and determined that generally that's information that should be known or is known by governments, because generally, at least for general purpose governments, it's budgeted separately. For special purpose governments, it may not be as budgeted as clearly as others. But and so the board is aware that in the year of implementation, there potentially would be additional costs, but on an ongoing basis, that generally it would
not be significant costs after the year of implementation. Thanks. I appreciate the comment. I think that's also an area that as we interface with our members, we need to make sure that they're cognizant of the materiality aspect. A city government, you got streets and all sorts of things. A lot of public institutions, yes, they've got streets on campus, but it's the city's responsibility. So again, the materiality aspect is something we'll need to make sure people are cognizant of.
Yeah, and I should have led off with that a lot of the larger infrastructure items generally are not applicable to colleges and universities, although there are some that have the streets, but most don't, as you say. So a lot of the requirements in the preliminary reviews won't be as applicable to colleges and universities.
Chris, just to be a little, to respond to a couple of things I heard, at least I thought I heard you say. One, I think you said if it's not broken, I think our research showed that it is broken a little bit, that users told us two things in particular about infrastructure. One, they didn't feel like the carrying value on the face of the financial statements was always very reflective of the condition of infrastructure. And two, they wanted more maintenance, more information about what they call a deferred maintenance liability. I think somebody even here already said deferred maintenance already earlier in this meeting. So it's a big issue for users, and they talk to us a lot about it. So we're trying to respond to that, right? And so the proposal, which I would, I'm sure you will go through kind of in detail, and we look forward to the comment letter. And for a college university kind of meant, like what do you see in there specific to you, and what are your thoughts? But that's what we're trying to respond to. And we did not include, and there's a chapter in the PV that says why we didn't do deferred maintenance, but this maintenance expense disclosure in the RSI table is a response to try to give users some information about maintenance that has happened and maybe was budgeted in the past compared to that what has happened that they don't currently have. And so it's a step towards, them informing, is the government maintaining their infrastructure or not, and kind of somewhat by how much. So that's what we're trying to do, is balance something, as Scott said, we think is maybe less costly and is appropriate for external financial reporting with the benefit to the users. And we felt like that achieved it, but we look forward to the comments. And somewhere in there, you said, it made me think like we were trying to project what needed to be spent on maintenance almost in the future. And there's no part of the proposal that does any of that. The only, I don't want to call it projection, was the budget amount in the RSI schedule that would be past budgets, not anything about future budgets. So maybe I misheard what you said, but that's what the proposal calls
If
for.
I implied anything about projections, it was a mistake. I didn't mean to.
I probably misheard. No
but
worries.
I think a lot of the concern comes from that budget to actual comparison. And, if you get, somebody that wants to stir the pot a little bit, they could go back and look and say, oh, well, this campus street, they've only budgeted, this much, and they haven't spent that much. Are they really doing what they're supposed to do? And the comments we got, people were just thinking that opened the door unduly to litigation and, public relations type battles.
Our initial information is that users really want that information, right? And so that's what we're trying to respond, but we look forward to your comments, right? To hear all sides. Jeff, sorry.
Sure, I'll jump in as sort of a coming from the user community and want to reiterate what Joel said about, we've heard loud and clear. I think it was interesting, your choice of words there. If it ain't broke, don't fix it. I think that's what users are concerned about, that they're not fixing it until it's broke. And I think, when we did the research, we heard a lot from users that they love the modified approach. But the board recognized that the lift on the modified approach would be too potentially costly for governments to undertake. So what the board, I think we're trying to do, or the way I see it, what we're trying to do is trying to give users that information, whether it's trend information or comparison information, so that they can start to get some information so that they can compare who do they think. And I agree 100%. I don't think higher education was the focus of what their concerns were, but more general governments, but that they're trying to get to where they can start to make some distinctions about who do they think is spending appropriately to maintain their infrastructure and who is not. So that, because they really do have this concern, as Joel was talking about, that there's a liability out there that they just don't know about. So I, like Joel, am very interested to hear the feedback we receive on that, but it's been an important consideration for them.
Yeah, and that's a fair point. And, I understand. Full disclosure, I've always been a preparer, so that tends to be my lens. But yes, fair point. Thank you.
Anybody else on this one? Revenue and expense recognition.
With revenue and expense recognition, kind of coming at that from the standpoint of we think we may be able to provide some background to the board as you go through your deliberations, specifically with respect to sponsored research. Your federal grants, your NIH types of things. Currently, the exchange non-exchange paradigm is fairly clear about when you would call that an operating versus a non-operating revenue. As you're working through the ramifications of Category A, Category B, we thought that maybe we could provide a little bit of flavor for an activity that is probably not real common among general purpose governments. Did I miss anything?
No. So one of the things that strikes me is we try to follow along and look at and read the meeting recaps. I don't get to listen in on every meeting. Luckily, Chris has joined the team and can do that, but there's a lot of new terms that I see sometimes on the revenue recognition project. And I know you're getting into the discussions of Category A. And so when we were thinking about research grants, and we went through this with the nonprofit private institutions when FASB did their revenue recognition project. Research grants can be tricky because you've got performance obligations throughout. You often bill or invoice when you've completed a performance hurdle. If it's a federal agency that sponsored the research, or another grant making type of organization that sponsored the research, we've thought of those as reimbursement grants, and we followed Statement 33 and they're non-exchange. We have seen some variation in practice, to be honest, though. Sometimes the sponsor of the research looks at the college as an outsourced research provider. And a clinical trial, for example, might be the most common. So there are performance hurdles built into the agreement. When you reach certain hurdles, you are invoicing, seeking reimbursement for the work performed, depending on how the agreement is structured. But I'm trying to parallel these. They're not really considered, we don't think they're considered reimbursement grants under Statement 33, but we're not going to have Statement 33 any longer. So we were kind of, well, I don't know. I'm just making an assumption. So my bad. It was always a favorite of mine, but so so that's why we wanted to have the discussion, and we don't know like how far down the road you've gotten, but kind of your thoughts on the notion of agreements and performance hurdles for two very different types of research activities. I don't know if you can get different answers within the A and B framework.
I think you would. Most certainly. I think the way you reflect into current guidance in 33 is very consistent to the way we think about them too. There's some research grants, and this very strikes me as the comment you were making earlier. You've seen one grant, you've seen one grant. And so some of them are very clear. It's one for another, and you got to go to the exchange model. You have to stick that there. And there's some things that is really not, and clearly not. You got to stick to the other model, and then you have a very wide broad of maybes. And you have to exercise a significant judgment. And I think in the AV model, you don't have any differential in that challenge. And that you will wind up having some grants that is clearly a substantive right, a clearly substantive obligation in which were the parties and they're interdependent, you're going to go to performance. There are going to be some that you have clearly a substantive right, not an obligation, clearly substantive right, not an obligation, and then they don't get interdependent, you got to go to Cat B. And then there are going to be some that you're going to really struggle exercising the judgment, because we have seen a lot of examples where, particularly when the rights to the research is sort of grayish. And so the academic can publish, but they have the right of refusal. And that's when it gets really murky. But when you have a clear deliverable to the counterparty, and when you have clearly no deliverable to the counterparty, and which is not very different from when you have exchange or non-exchange today. So the same degree of challenge, I think you're going to have. And so we don't see research grants, whether sponsor or federal government or the trials that you see it, any different. We think they have to be run through the model, run through the questions, and it's going to wind up in one or the other. And some of them are going to be very great, like they are today.
One question I have is, in your mind, is there a possibility that you could have a single agreement that would end up being bifurcated between Cat A and Cat B? Okay.
We see that with you guys a lot. I mean, in higher ed, you have those fundraising things where you have the $10,000 dinner, and then there's a piece that is a dinner and a piece that is a donation. You tend to have those things. So it wouldn't surprise me if you wind up in a research grant that you have to bifurcate.
We love when you put examples in the standards. And we did find, I think not-for-profit institutions found that the other standard setting boards spent a lot of time working through the various situations that you were talking about, and it was helpful, and then it led them to expose new guidance and eventually write a standard. So we look forward to kind of that discussion and those examples, but yeah.
Well, I might just take you on that, because I think the struggles when we were crafting the examples is how do we create? So the gray ones, obviously, you're going to be the gray side. But we would love to be able to work with you to have the clear on one side, clear on the other, and help through the judgment so people can get there consistently. And so then when they get to the grayer area, they at least have a basis to make those decisions, because that's where we struggle. I think if you have fact patterns in the middle, it's going to be depending on how a tiny tweak in the next grant agreement resulted that gets you to a different conclusion. But so we have to, when we elaborate in examples, we have to get somewhere to the point where we can help you figure out what was the trigger this conclusion, or what was the trigger the other conclusion.
So a takeaway today might be for us to find some interesting agreements or.
So my favorite ones are the ones that I can see. I love the DARPA grants, but nobody can share them with me. But certainly, if you have it, please send them over, because it would be very helpful for us to help also create illustrations with them. Because I understand what you're asking me.
Thank you.
Unless there's any other questions or comments from the board or staff on what we've said here on revenue and expense recognition, that sort of wraps up our prepared remarks. Before we get to the closing comments, just want to make sure everyone has had the opportunity to ask questions about any topic that might relate to higher education, not just the ones we've chosen to throw up on the screen. So please, by all means, ask or comment away.
Board members have questions or team? Paulina?
I do. So one of the areas that we're beginning to work with, as you alluded, is in the category part of the model. And we're working through some questions about how frequently do you hide. And I don't see this in higher ed prevalence, but I wanted to hear, and if you have examples, please call us offline. We're looking through concession arrangements. We're talking about build and hold arrangements, and we're talking about repurchase arrangements of goods or services. Don't get that, but so inventory kind of situations. And the only example that I've able to be able to run into from a field test is higher ed hospitals having consignments of medication. But I have not run into other examples. And if you know it or are aware or have a case, please give us a call.
Right off the top of my head, I couldn't add to that list, but I will.
Yeah, no, I don't think they're prevalent. We have asked an awful lot of people, so we are getting the feedback that it's not prevalent. And if there are, they're very immaterial. And the only one that troubled me was the medication, only because the people who participated in the field test just got completely tied up in a knot and couldn't work through because it was a concessionary arrangement. So the pharmaceutical company will put it in the hospital. It's not the hospital's inventory. And then when they dispersed it to the patients, that had to work through that mechanic, and they were really struggling. And so that was the only example I've ever seen. But I wanted to make sure if any of you have anything, just let us know. Even if the answer is no, we don't have them, we don't see them prevalently, that alone helps us. Thank you.
Thanks, Paulina. Anybody else? Alan, you?
Yeah, just real quick, I just kind of almost as a closing comment before you and Sue make yours is everything we do really revolves around feedback, and so even a day like today is really good because we get feedback and we get information. But I'd be remiss if I didn't sit here and say that we talked about the infrastructure PV that's out there till January 17th, if I'm not mistaken. But as of yesterday, there's actually an ED on subsequent events, and there's an ED on the implementation guidance update. In the spring, there'll be one on going concerns for financial stress, PV on that. But just you have time, the comment letters and the feedback and the electronic feedback form is really important for us, and we hope you continue to do that. I know you typically do. I know NACUBO typically does, but those are important for us because that helps us. And as we notice even this week, sometimes a single comment from a single stakeholder makes us actually make a change in the literature. So I know they're kind of a little cramped and they're a little bit all in January and September and February window, which isn't perfect, but they're spread, I think, enough to we can get through them. And so we just look forward to the feedback from those due process documents we have on the street right now.
Anybody else? Do you want to have closing remarks, Sue, and then I'll go? Is that fair?
Yes, thank you. So I think this was a good meeting for us. I think we received a few points of clarification today, and we felt like you were really listening and, made some comments that helped guide us. So we thank you for that. We would also like to say, in general, we appreciate opportunities to work with the staff, especially if there's something that's unique in our sector that you may not be seeing across governmental organizations. Please call on us. We think that that helps us provide guidance and have great discussions and professional development programs for colleges and universities. So we just want to make sure that you hear that. And we will do our best to comment, maybe before the 11th hour even. So we promise you that. And it was evident to us that you do, especially in the compensated absences exposure draft, that you really listened to some of the feedback that you received. So thank you for that. But mostly, this has been a pleasure to come to Norwalk. It's not an easy place to find, especially the new office. But we've enjoyed our visit. So on behalf of all public colleges and universities, thank you for working with us and for considering us an important constituent of the work you do.
Thanks, Sue. I'd like to close with, I referenced earlier, you guys talked about resource constraints. I referenced earlier, it's broad in the whole public sector. We're aware of that. We're, trying our best to do things we can do to not add to the challenges that you have. One of the things we're doing is we've set a really high bar for the board to undertake a project. We know that when we edit gap, we add to gap, we're asking you to use those resources on something you otherwise wouldn't have to. And so for us to ask you to do that, we've made a really high bar for us to undertake a project. We think that projects need to have a really significant potential improvement in the financial report. Otherwise, we're not going to undertake them. Our agenda is much smaller than it has been in the past. And in fact, we only have 5 projects on it right now. And we've talked about 2 of them. Alan referenced 2 others just a minute ago that we passed an exposure draft on. Going concern, you mentioned that one too. Those are the 5 projects. That's all we have on the agenda. I apologize a little bit. They're all coming, almost all coming for due process documents at one time. I know that's kind of a lot. We did try to stagger, have pretty long comment periods, stagger the comment due date. And you guys are always great about commenting. We certainly hope that continues and look forward to that. But so even though there is a lot of due process documents, that's all our projects right now. And so we're gonna maintain that high bar. It's our goal. And so that we're just conscious of the resources, even though we do have a lot coming out right now. And thank you for coming. You enjoyed coming. We enjoyed having you. We appreciate your time. We appreciate the comments. We appreciate the input we get from Anita on GASAC. I know she couldn't be here today, but we saw her earlier this week at the GASAC meeting. She's a really great representative for you guys. But we're always available for you to bring us challenges that you're experiencing, whether it's with standards or in the industry or things you think we can help you with. Certainly never hesitate to call any of us at any point in time, but we appreciate all the engagement that you provide and comments and look forward to that continuing.
If I could just real briefly give a shout out to Joe Wickland and to Alan. They've been great about listening to me ramble on at various meetings about the things that I think should be done or should not be done. And I appreciate working with both of them.
We appreciate that. It makes us better to get input along the way, after the fact, before the fact. It never hurts to hear input. So we're always open to that and appreciate you providing it. So I think if there's nothing else, that will conclude the liaison meeting. And for the board, that concludes our board meeting for the week. I guess for anybody that's interested, including all of you NACUBOs, our next board meeting is December 11th, 1 p.m. Eastern. It's a video conference where we will be talking about going concern and severe financial stress. But thanks, everybody. Meeting adjourned.